Welcome back, everyone. I'm Avette Ingleton, and today I'm running this one solo. Because when it comes to small cap stocks, you need a guide who can cut through the noise and show you what actually matters. Now, I can tell you what to buy, hold, or sell, but I can tell you this: you'll want your pens and pads out for this one, because the next few minutes might change how you look at small caps forever. Let's start with the one that's been making the most noise. Sable Offshore. Sable's been on a tear, but here's the part most new investors miss. It's not just the price action. It's why the money is flowing in. This move didn't come out of nowhere. Sable just secured a major offshore contract, and that single announcement completely shifted how the market values their next 12 months. Look at this spike right here. That's not hype. That's institutional money reacting to new revenue visibility. And when the big players move first, they leave a footprint, meaning you can literally see their activity in the chart. Before the rest of the market catches on, institutions don't tiptoe in. They move in size, and that volume creates a trail you can spot if you know what to look for. Now let's talk about T1 Energy, ticker symbol TE. This stock's up 11% recently, and year-to-date, over 110%. With a market cap near $1.78 billion, it's officially graduated from microcap territory. But it's still small enough to move fast when the right catalyst hits. And that catalyst just landed. T1 signed a 3-year deal to supply Treaty Oak Clean Energy with 900 megawatts of solar modules, all built in Texas, using domestic solar cells from their upcoming G2 Austin fab. That's not just patriotic, it's strategic. New federal rules on foreign content mean traceable, US-built supply chains are suddenly a competitive advantage. T1's also expanding its footprint with a 5.3 gigawatt solar cell facility, complementing its existing 5 gigawatt module plant in Dallas. Together, they're positioned to meet rising demand for FEOC-compliant solar tech, and that's exactly what Treaty Oak needs. Now, here's what matters for anyone just getting comfortable with small caps. When financing gets cheaper and demand picks up, industrials like T1 don't just benefit, they accelerate. And when a company's pipeline gets validated by a deal this size, it's not just a price move, it's a signal. Up next, we have Redwire, a small-cap space contractor that just surprised the entire market. Here's why this chart exploded. Redwire just secured an 8-figure European spacecraft docking contract with the Exploration Company, the team behind the reusable NYX capsule. This deal includes 2 IDSS-compliant docking systems, and it instantly positions Redwire as a key supplier in Europe's push for autonomous access to space. Now look at what that did to the stock. RDW logged 3 straight days of gains, with intraday moves hitting 10% before settling around 3 to 6% higher, depending on the session. That's not retail noise. That's institutional volume reacting to a real revenue catalyst. And this isn't happening in a vacuum. Analysts have been warming up to Redwire all month. Canaccord Genuity reiterated a buy rating, calling Redwire one of the most compelling aerospace and defense plays thanks to its shift from commercial space to a defense-first business model. They specifically highlighted Redwire's tech stack, things like the Rollout solar array and the Stalker UAS, which are already being pulled into Army programs. And if you zoom out, the momentum is stacking. Just weeks before the NYX deal, Redwire landed a $4.4 million DARPA contract for its Otter VLO mission, the world's first air-breathing spacecraft concept. That's defense, that's recurring revenue, and that's long-term contract visibility. So here's the pulse. Redwire is still a volatile small cap. And yes, they're burning cash. but the combination of a 10 million European contract, a 4.4 million DARPA award, and a clear pivot toward defense-grade tech is exactly why this chart broke out. If this momentum holds, Redwire might be one of the most interesting under-the-radar Meyer defense hybrids heading into 2026. And to close this out, we're ending with a bang. Fuel cell energy. This one didn't just move. It erupted. Fuel cell just dropped a fourth quarter that shocked the bears. Revenue came in at $55 million, about a 12% jump year over year, and ahead of what analysts were expecting. The market's reaction: the stock ripped roughly 35% in a single session, with intraday gains north of 33% as traders scramble to reprice the story. But the real headline isn't just the quarter, it's the pipeline. Fuel cells backlog climbed to $1.19 billion, up about 2.6% from last year. That's $1 billion plus in contracted work, signaling real demand for their clean energy and hydrogen platforms heading into 2026. Zoom out and the momentum gets even louder. From the lows earlier this year, FIL is now up more than 70%. That's a full trend reversal from forgotten penny stock to wake-up call on the chart. Full-year revenue hit $158.2 million, up 41% versus last year, and the company boosted liquidity to around $341.8 million, giving them more runway to execute. Now, here's the flip side. Fuel cell is still losing money. One report flagged a steeper EBITDA loss versus last year, even as another highlighted narrowing net losses overall. Translation: the business is improving, but it's not out of the woods yet. This is still a volatile small cap with real execution risk. So how do you treat a move like this? If you're trading, this is pure momentum. Watch that volume and don't chase without a plan. If you're investing, the story is the $1.19 billion backlog, the 41% revenue growth, and the pivot into powering energy-hungry AI data centers, which management is now explicitly targeting. Bottom line, fuel cell just reminded the market, it's not a dead ticker, it's a high beta, clean energy swing with real contracts behind it. All right, loves. That wraps up today's market rundown. We covered T1 Energy, Sable's breakout, Redwire's momentum, and fuel cell's explosive move, a full spectrum of plays to keep you sharp and ahead of the curve. And remember, always do your own research when investing, and if you ever feel unsure, don't hesitate to seek guidance from a qualified financial advisor. If you're learning and enjoying, please like and subscribe, and please leave a comment so that we can continue to improve CCI for you. Your feedback truly shapes what we build next. And I'll see you on the next episode, where we bring in a heavyweight, someone with the kind of experience that can shift how you look at the market entirely. You won't want to miss it. And as always, have a blessed and financially successful week ahead.